the rate. So the rate's 3%.
Yeah.
Then it's going to be 1 plus 0.03 to the 251st minus 1.
Yeah, but is the other, if you plug in, well, that's the daily rate. If they give you the monthly.
Yeah, so in order to convert these, it's probably going to be like 1 plus 85% or something like that. No, this is a bad, this should be 0.0 for a better example. But, yeah, it's just, for a monthly. So it depends on what numbers I'm starting with. If I'm starting with returns between a monthly, I'm looking at end of December versus end of November, then I'm going to take the monthly and do it. If I'm looking at Tuesday to Wednesday, then I'm going to look at the daily.
Okay.
Yes.
For regarding the question in the assignment, where we have to calculate RMs, the rates are given monthly. So what you are saying is that we have to average out those rates for the given period we are looking for, and then put in this formula of RY is equals to 1 plus Rn to the power 12 minus 1. Yeah.
I would probably do something like that.
That's what we did.
But when returns are given monthly, not when returns are given daily. When returns are given daily, you do it.
And then you would have the R, kind of the return you expect from that kind of stock, right? So which things you should get for that risk on.
I would probably do something along the lines of beta if I were looking for expected
beta,
rates of return.
If you have beta.
If you have beta, yes.
If you estimate the beta, say.
Yes.
And then you have the and the risk-free. And then you get the RE, and I'm just saying the RE would then be the return you'd expect for the stock which has the beta I estimate.
Mm-hmm.
Okay.
Back to the assignment.
So does anybody have any questions on CAPM?
Yeah, I mean, just give it your best shot. Go for it. Explain it.
Explain it? So RI is the required rate of return on an investment. And that's calculated based off of what we can get risk-free. And this comes back to this model. That one, Windows Touch.
Is that the capital market one?
Yeah.
Okay, just checking.
Again, not paid for this. So it comes back to this.
Keep saying that.
I don't know. Him passing this exam doesn't look too good either.
There is a risk-free rate. And so we're looking at what the risk-free rate is. So to figure out what the required rate of return is, I'm going to look at the risk-free rate, and then I'm going to look at what the market is doing on a risk-free rate basis, so the excess return on the market. And then I'm going to adjust that for some factor, and that's beta.
Okay.
And the beta is, in theory, the beta is how much change a stock has, or the risk premium, basically, compared to a market. In reality, and I saw it in his book, it's really what we say, okay, a stock is doing whatever. It's based off of the amount of money it can earn and how good the company is and how good the people are there. So then, if I'm a technology stock and I'm trading in this technology market and I'm Google, I should be priced based off of how well I make money. Well, if something happens to Yahoo and they go and that moves the whole market, all of a sudden people think, oh, technology stocks aren't that good anymore. What's the beta of Google so that I can then understand if Yahoo goes bankrupt, what's that going to do to Google?
Is it kind of like the derivative? Or is it kind of like giving you room, the wiggle room for error or the worst case scenario?
No, it's really what it is it's, I have my company doing something. What happens if something that I can't control happens? And to the extent that beta is large, big things are going to happen to my company. To the extent that beta is small, not very much is going to happen to my company. For external factors that I can't control.
So you want something with a small beta.
Typically.
That's what they refer to usually as responsiveness to market?
Yes,
okay.
Absolutely. And that's really how it's used. If you really want the buzzwords on Wall Street right now, the whole thing is risk on, risk off. And on daily, sometimes monthly basis right now, traders are saying either risk on or risk off. And so when they feel like everything's heading towards a recovery, they want to pile a bunch of risk on. So they're looking for very high beta names, very high beta currencies, very high beta countries to invest in. When all of a sudden we decide that Greece is going bankrupt again, because that happens 3 times in a week, we say we want to go risk off, and we look for very low beta names. And so people are trading on beta. They're not taking beta and saying this price should be that. They're saying, oh, this. In general, if the whole market moves, this stock's going to move a lot. In general, if the whole market moves, this stock's not going to move very much.
Okay, and the RI is, what does it
That's the required rate of return. So that's what we use for our discounted cash flow. It's also
similar to the one that Nana was asking before?
the internal rate of return. If net present value was 0, yes, it's RI is the rate that the return that I'm requiring from this company based off of its
What
risk.
do you expect as an investor?
So if I then had a bunch of cash flows from that company, and I were to discount them at that rate, that should give me the price that I would be willing to pay for that stock.
Sorry, say that again. Was that the RE?
Yeah.
Okay, good.
Yes.
Could you explain a little bit with detail? For example, when RC is going up, how to describe in the graph? I don't understand the relationship. How the formula and
This
graph.
relates to that?
Yes.
You're going to ask me a question that I don't know either. I don't know that answer. I just know that it's derived from that.
Always the professor they told the formula and draw the graph.
The graph.
I don't understand always. So how important it is, I don't understand.
The relationship between the formula and the graph?
Yeah, so you're going to ask me a question. I can kind of try and explain it. If I do that, though, I'm afraid I might confuse you more because I don't fully. I know that they relate. I can't point to the exact math that it does. But basically, what this is here is the return of the market minus the risk-free. That's the risk of the market. So that's what the market does. And according to modern portfolio theory, we can diversify away market risk. So by having good diversification, that's that curved line, we can diversify away market risk. And so then the beta is how a stock reacts to the market. So the risk that the market has. Yes?
The point of intersection is RM, right?
I don't know that answer.
Yeah, I think so, because if I see this as the equation of line,
I don't know if that equation actually fits that line.
Yeah.
I want to be really careful here because I don't know that answer.
because Herbert told us that when it intersects the y-axis, that is the risk-free, RF.
Yes, I know that this is risk-free, but I cannot tell you that this is beta RM plus minus the risk-free. I can tell you that if I had a bunch of returns like this, that then you can, this line that goes through there, that relates to beta and to an intercept. But for me to go beyond that, I shouldn't do that because I would be getting information.
In practical, beta is the responsiveness of a particular stock compared to the overall market stock in where the stock is sold. I mean, for example, in Amsterdam, in Netherlands, so Ahold, beta Ahold is Ahold stock compared to the overall stock in Netherlands only.
So they put an R squared to this value, and R squared is how well, or explains how much of the change comes from that formula. And yes, there are indexes that have much higher R squareds to a particular stock than other indexes. And in general, you should try and fit your stock to its index.
Okay, so for example, the beta of Yahoo, which is sold in US, then it only relates with all stock markets in US only.
I'm not saying that it only relates with stocks in the US only, because what happens in Greece does affect Yahoo. But thought if I were trying to fit my beta to a specific index, I would probably use a U.S. index because there's more factors in the U.S. than globally, at least in 2000.
Is there some kind of values for
Global
global
index.
There are global indices, and as things become more global, I think you'll find that they fit better. I don't know what the R-squareds are for these. I don't for Yahoo, but in general, a tech stock should sort of react like other tech stocks. Now, obviously, in an emerging market, you're going to have a lot more volatility because there's going to be a lot more market volatility. But if they're the same business plan, same tech company, same risk factors, they should react fairly similar. They should have the same profits whether they're in Indonesia or the U.S. Now, what the Indonesian market does to that stock could be drastically different compared to what the U.S. market does to the U.S. company. So yes, you would want to relate your beta to an Indonesian company.
That
Good.
would be the RM, right?
What's that?
The RM.
Yeah, the RM can be different. It doesn't have. There's not one.
Yeah, that's exactly what you were talking, like, depending on the index, I take Indonesia or Colombia or whatever.
Yes.
Risk-free is always bond.
Risk-free typically is a 3-month government bond.
Oh, that's why they write 3M.
90-day T-bill would be a 90-day treasury. We'll talk more about that when we get to bonds. It's usually a 3-month government bond. Is usually the risk-free rate. Usually.
And that would also be different for, so if you take the US market, then it's better to take US risk-free.
Yeah. Risk-free here could be a different risk-free from Indonesia.
Yeah, so depending on the market, take that.
Yeah. But if I'm a company in Indonesia, I would want to use the Indonesian risk-free rate because there's too much currency risk to try and transition to a different dividend discount model, which is P0 equals P1 divided by R.
Is it a P or a D? Sorry.
What's that?
D or P? P.
This is a P, that's a D.
Oh, okay. What is that?
This is not as useful for maybe what we're doing last night or
Gerard, I
this week.
think there is a mistake. It's R minus G.
Professor, it's not looking too good for him, is it?
But I don't remember this formula. Did we discuss it?
No, but because I know what he wants to do. So it is the interest to go on, and then and R is to go back, and then they must be subtracted. G is the interest to go on. So what you expect in the future, R is the discount rate, what you expect on your own.
Yeah, so they should be.
And then they must subtract each other.
So G is the growth rate of the dividend. So when we're looking in real life and we're not estimating future cash flows, basically you're given, analysts will estimate what next year's dividend is going to be. They'll also give you a growth rate for that. And then you can use that to either set right now's price if you know the return that you're requiring out of the stock, or you can find the return that you're requiring out of the stock based off, and you can solve for any of those variables.
Sorry, what is the purpose of that formula?
This formula, I can either, and this is P0, I can either say what the price of a stock should be based off of its dividend and the growth rate of that dividend. I could say what that stock should be worth right now. Now, let's say I throw everything in, and it gives me an answer of 45. And the stock that I did the analysis on is trading at 35. I would say that it's time to buy that stock because I think it should be valued at 45 and it's really at 35.
Can you repeat the whole story?
Sure. So D1 is, let me start there. P0 is the price of the stock right now. D1 is next year's dividend rate. Usually that's given by an analyst. Usually they'll say, or not necessarily an analyst, but a company will come out and say, next year will have this dividend rate.
But that dividend, it would be all the additions if you get paid monthly, for instance, it would be all together, right?
Yeah, so it's going to be your rate for the year.
Okay.
And then you're going to divide that. Actually, it's $1.
It's a what?
It's $1 amount for the year.
R.
D1. So they're going to say next year we're going to pay $1.70 in dividends.
Dividend per share.
Per share, yeah. Divide that by the required rate of return, which I can calculate from beta or a billion other things.
What is this R if I relate it to that formula? It is required rate of interest, RI?
Required rate of interest. Required rate of return. And G is only if we expect the dividend to grow. If we don't expect growth in the dividend, we don't subtract G.
Would that be a percentage?
Mm-hmm. It's a percentage.
And that is growth compared to year 0 or year 2?
Year 2, from 1 to 2.
So
And that's growth of the dividend, not growth of the company. Growth of the dividend.
Provided by analysts. Again.
Yeah.
Can we do it as an example though, sort of, because what trips me up in the class is like doing all this hypothetical. I just want to see it in action, like on a test. What are they going to ask? How do I relate that formula to that?
But this exam is closed books, right? Like nothing.
He doesn't know yet. Ask him.